All right, we are live again. Welcome everyone for joining for yet another week of Taxes in Retirement Live. Tonight's topic will be ACA premium tax credits, where ACA is Affordable Care Act, otherwise known as Obamacare. These are tax credits or subsidies, is another way to think about it, that you can get for buying health insurance through an ACA plan, an Affordable Care Act plan, not just any insurance, but one that qualifies as an ACA plan. So we'll be talking about that. Let me start with the dad jokes of the week. I have some other winners that I'm proud of this week. So let me get to it. So many people these days are too judgmental. I can tell by just looking at them. I really wish I had some sort of hype man here on the side to bounce this off of. It's a little weird telling a joke and there's absolutely zero response. I know these are funny. Hopefully you all agree, but it'd be cool if I had like some sidekick here to chuckle and cheer me on. Next. When I was little, my parents always fed me alphabet soup, claiming that I liked it, but they were just putting words in my mouth. And finally, this one's a little edgy. Hopefully you're all right with it. What do you call a person who eats other people slowly? A can nibble. As in cannibal, but can nibble. Small bites. Take small bites of people. That's it. That's the dad jokes. Painfully good. Painfully bad. So bad they're good, as I like to think of it. Willie, very funny. Thank you. Yes, thank you. Good to see some people. And a chuckle from Richard. Thank you, Richard. I appreciate that. All right, so let's get going. So, as always, feel free to comment, question, whatever. Again, there's a 20 or so second lag on it. For those of you who are new to these things, thank you for joining. Hopefully you enjoy it. I sort of batch up the comments. I won't answer them all in real time as they come. Plus, sometimes I get so worked up and carried away with what I'm saying that I don't focus on the comments here on the side of the screen. But point is, I will get to all your comments and questions here. So feel free to drop them as you have them. All right. So ACA, Affordable Care Act, again, otherwise known as Obamacare. It's private health insurance that you buy on what's called the government exchange or marketplace. You go to healthcare.gov. That's where you can go to find and apply and get price quotes and get estimates of these tax credits right on that website. It's actually really good. I know it had its problems when the thing launched in like 10 years or so ago. It crashed on the first day, but the site's actually pretty slick, pretty clean. I personally used it last year when I left my corporate gig to start my planning job. I did look to see what insurance would be on the exchange, so I went through it all myself. Now, I will say that the policies can vary drastically depending where you live. Not all insurers sell policies on or through the government exchange. The ones that do don't sell in every state. The ones that do sell in certain states, they could price things drastically differently depending what county you live on. And because it's health insurance, it also depends on your age, your gender, and general health status. I may or may not matter. So one of the whole benefits of Obamacare was that you can't be denied coverage because of pre-existing conditions. Now, I don't know if that means they can't charge you higher premium for certain other conditions, but you can't be denied. I don't think. I'm not a health insurance expert, but that's my knowledge of it. So why are we discussing it now? This comes into play a lot for people who are early retirees, and I'll explain what I mean by that. But it's not just retirees. It could be anybody. Like I said, I'm 42. I looked on the exchange, healthcare.gov myself last year to see what a policy would be for a family of four. It's not cheap. I mean, there's different options, but there are possibly tax credits, which is what tonight's session is about, that can substantially defray that monthly premium cost that you'd otherwise have to pay for these policies. So why I said it's often a common thing for early retirees is, think about it like this. Let's say you stop working at 55, 60, whatever. Point is, it's well before 60. I may have said 65. I meant 60. My point is, you stop working well before 65, which is Medicare eligibility age. Once you hit 65, boom, you go on Medicare. Everybody does. It's not really an option. You have to, or you get penalized if you don't, basically. But let's say you stop working at 60. And let's assume, so what do you do for healthcare? Well, there's a handful of options. I did a video about it on my YouTube channel if you want to see. There's 5 or 6 options. But In a nutshell, it's either self-insure, which means don't get insurance, just wing it, hope nothing happens. If it does, pay out of pocket, but that can be catastrophic, obviously, if something bad does happen. If your spouse has coverage through his or her job, great, get coverage there. Maybe your employer will extend their coverage for you. Not COBRA, but maybe as a retiree, they offer it as like a retiree benefit where they'll let you keep that same insurance. Maybe you pay more, but the point is you seamlessly keep the insurance. There's also faith-based health sharing. Usually it's around the Christian faith, but it's not technically insurance. It's loosely looks and feels like insurance, but it's not in a technical legal sense. But that's a possibility to join one of those things. There's lots of pros and cons of doing that versus traditional insurance, but it's an option nonetheless for some people. You can also, everyone can extend the coverage you had through your previous employer through what's called COBRA. It's a government act/law that says usually it's 18 months. In some cases it's longer. But whatever policy you had at work, you're entitled. You can opt to keep that for another 18 months. Now, it's the exact same coverage, exact same policy. The difference is you pay the full sticker price of the premium plus, I think it's either 2 or 3% on top of it. So in almost all cases, employers subsidize the amount you pay when you get health insurance through them, and often they subsidize it pretty heavily. That subsidy all goes away. You're paying the full sticker price with COBRA. So COBRA isn't always the cheapest option. The other option, basically the final option, is to go on healthcare.gov, shop around, and go find yourself a private policy. Now, it is a government-run program, but it's not government insurance. What the exchange does, the marketplace, is really just match up buyers and sellers. The sellers are the big-name insurance companies, Aetna, United Healthcare, Blue Cross Blue Shield, whatever, whatever insurers in your state. The government aspect is just facilitating the process and setting some parameters around what types of policies qualify to be sold to this exchange. And then also the big part of it is these tax credits, which we're about to discuss. That's all facilitated through this government exchange. But again, it's not government insurance. Like Medicare is government-run insurance. Insurance bought through the healthcare exchange, even though it's a government program, it's not government insurance. It's still private insurance, all said and done. All right. So anybody can sign up for and buy insurance on the government exchange. There's certain times of the year you can, or if you lose coverage to a job, you can do it then. But point is, anyone can buy it. Not everyone can get these tax credit subsidies. There's a handful of things you need to do to be eligible to get it. One is, well, first and foremost, you need to have a policy that you bought or will be buying through the exchange, right? You can't just go find your own insurance somewhere. It's got to be through the exchange. You can't have access to another qualified plan through like an employer. Now, COBRA does not count. So if you stop work, you retire today at 60, you can extend your employer coverage for 18 months on COBRA. That does not count. You can opt to forego COBRA and put yourself in an ACA policy. But if your spouse is working, for example, and you're able to be added to your spouse's policy, you don't qualify for getting these premium tax credits. You can still buy yourself an ACA policy if you want, but you're not eligible for these subsidies because you have access through your spouse's plan. Also, if some retirees have a what's called the HRA, or health reimbursement account. It's a retiree benefit that your old employer may give you, which is a small little pot of money or stipend each year to help you pay for whatever insurance you choose. If you have an HRA, health reimbursement account, you're not eligible to get premium tax credits. If you're married, you have to file your tax return jointly. You can't file as single. You can't file separately, married filing separately, unless there's like, I forget the term. If you're an abused spouse, or you need a domestic protection order or something, then you can file separate. But otherwise, you can't file separately if you're married. If you do, you're ineligible for these tax credits. And there's not to get off track, but there's lots of reasons not to file separate. If you do, you lose lots of access to credits like this. Smaller, you lose other credits, and deductions aren't nearly as favorable in almost all cases for people who file separately, married separately, as opposed to married jointly. So anyway, if you're married, you basically have to file a joint return to be eligible for these credits. And finally, this is kind of the big one. Your modified adjusted gross income needs to be between 1 and 4 times the federal poverty level. And I'll walk through what those are. It's one question I've seen before. I haven't gotten a found a great answer. Someone asked me what happens if your income is below the federal poverty line, below 100% of the federal poverty line. Then what happens? Well, you're not technically eligible for, in most cases, you're not eligible for these tax credits then. At that point, you go on Medicaid or TRICARE or some other sort of government subsidized program that's not this. That's all I really know about that. Like one question I had from someone in the group actually a couple of weeks back was, what if my income is so low, I get it to be zero, I'm below 1 times the federal poverty level, so therefore I don't really qualify for ACA, but I have too many assets to qualify for Medicaid. So, my response, and I don't know that this is the only option, but was like, well, just juice your income a little bit, pull yourself $15,000 from somewhere just to get some AGI to make yourself eligible for this, but still stay at the lowest end of it. So anyway, I'm not entirely sure what happens if your income is below the federal poverty level and you're not otherwise eligible for Medicaid. But generally, the point is if you keep your income, your AGI, modified AGI, and I'll discuss what that is, between 1 and 4 times the federal poverty level, you'll be eligible to get some of these subsidies. And again, I'll walk through the poverty levels. All right, so just quickly, super high level, I don't want to make this about the ins and outs of insurance, but I just think it's important to know. So for those of you that haven't already researched this stuff, when you go shopping for a policy on healthcare.gov, you'll see there's metal labels. There's bronze, silver, gold, and platinum. They're all ultimately the same policy. So let's see if I can do this explanation justice. So like there'll be one from, I'm just making this up, Blue Cross Blue Shield. They'll have some name for it. We'll call it Omni, whatever model they want to call it. That Omni, let me sit down for a second before I get into this. That Omni coverage, whether you can get it in bronze, silver, gold, or platinum, generally, it'll have the same list of doctors that are part of that network, the same list of services that are covered, the same formulary of drugs that are covered. So the coverage is the same. The difference is how much of that cost of the policy you shoulder versus the insurer shoulders. That's what the metal categories mean. So for example, if you buy that policy in a bronze version, you end up paying, what am I looking at? You end up paying about 40% of the total cost of insurance. So that means you have a higher deductible, you have higher copays, and you have a higher annual maximum. The insurer pays 60. So all the plans, this one's going to be the lowest monthly premium, all else equal, because you're paying more out of pocket otherwise. And then you go down the categories here. So next is silver. Silver insurance company picks up a little more. They're paying about 70% of the total cost. You're only paying 30. Well, guess what? There's no free lunch. That means you're going to be paying a higher monthly premium for the silver version of this plan than you would the bronze. And same thing goes down the line. You get a platinum plan, you're only paying 10% out of pocket for the most part for the insurance. Insurance company's picking up 90% of the tab. Well, that means you're going to be paying the highest monthly premium of all these four to make up for that. Because again, you don't get anything for free. You're paying for it one way or the other. I'll leave it there. I don't want to make this about shopping for insurance. That's a whole separate topic, but I just want to mention what the policy things are. And keep in mind, like I said, when you do shop around, they can be drastically different depending what state you're in. So, I don't have lots of data points to say. My experience in New Jersey for a 42-year-old with a family of 4 is going to be very different than someone on the other half of the country or, who's single or married and 60 plus. The results will be very different. Just to also add, some plans are eligible to have a HSA, a health savings account. Some aren't, so if that's important to you, you don't want to shop around to pick a plan that has a health savings account, because not all of them do. What else? All right, so premium tax credits now. They are effectively subsidies, but in the form of a tax credit. Specifically, it's a refundable tax credit. What refundable means, without turning this into too much of a tax prep lesson, when you do your tax return, all said and done at the bottom, it says you owe tax of whatever, I'm making this number up, $5,000. A tax credit, if you have any, will reduce your tax owed dollar for dollar by the amount of the credit. So if you have $1,000 of credit, your tax owed will drop from $5,000 to $4,000. There are refundable and non-refundable credits. Refundable means if the tax credit is larger than the tax you owe to start with, you'll actually get paid back the difference from the government. So let's assume you owe $5,000 in tax, but you have a $6,000 refundable tax credit. Well, guess what? Not only will your tax drop to zero, but the IRS or the Treasury will pay you $1,000. It's like negative tax, basically, if you want to think about it that way. That's refundable. Non-refundable means if your credit's larger than your tax owed, it'll reduce your tax to zero, but you can't go below that. You're not going to get refunded back the difference. So these premium tax credits are refundable credits, which are the best kind of credits to have because you can ultimately get paid out, depending how low the rest of your tax situation is. So that's what refundable means. The credits can be used on any plan, bronze, silver, gold, platinum. They cannot be used on catastrophic plans. Some states do offer catastrophic, which is very, very limited coverage. You pay a lot out of pocket if and when something happens and you need insurance. But for people who want to kind of wing it but not go completely uninsured, you can maybe consider a catastrophic plan. But catastrophic plans are not eligible for these tax credits. Only the bronze, silver, gold, and platinum are. So I mentioned, let me take a quick look at comments here before I keep steaming on. Get something to drink. Brian Williams said I blew it on the dad jokes with that shirt. Yeah. So yes, I went to University of Delaware, and there's a corny joke you may have heard of. If Mississippi gave Missouri her New Jersey, what would Delaware? Idaho, but Alaska. I don't know, but Alaska. I thought that was funny when I was 6. I'm glad Brian Williams still likes it, so thank you for pointing that out, Brian. Yes. Carol, are there any other sources to find insurance in addition to the exchange? Yeah, okay, so it looks like Jackie responded to you. Yeah, so there are some, I don't know if you were on in the beginning part of this video, Carol, but you can either go self-insured, meaning no insurance. You can try to join a faith-based health sharing program. You can get an ACA policy. You can extend COBRA through your employer up to 18 months, usually only. You can also just buy private insurance, like outside of ACA. You can call up Aetna or whoever's in your area and just say, hey, look, I need insurance. What can you do for me? They'll probably sell you a policy. It may not be cheap, but you can do that outside of Obamacare, outside of healthcare.gov. It's frankly, it'll take a lot of homework. If you are trying to find ways to fill that insurance gap until Medicare, it's just a lot of grunt work, just figuring out your options, pricing out the pros and cons of each and how much everything's going to cost, what's covered, what's not. In most cases, if you are usually Christian, the faith-based ones may make some sense. If not, I think healthcare.gov is probably I'm going to venture to say best for most people. Broadest source, ability to get tax credits, whatever. I see Jackie sent something. I don't know what FI Healthcare is, crowdsourced. So maybe worth looking into. Thank you, Jackie, for whatever that is you posted. Okay. Betsy asked, if the credits are based on your 1040 filing, won't it be inflated since you are no longer working? Also, are there some income streams that do not count? Yes, great question, Betsy. I'm going to touch on that now. So I'll come back to me if I miss something, but I think I'll hit on all your points in the next handful of minutes. Right, so Jackie responded back to Betsy. Thank you. All right, let's go. Cool. So let me just mention the federal. I'll save that. Hold on a second. So the modified adjusted gross income. I don't have a slide for that. I thought I did. So the measure of income they use to determine if you're within 1 to 4 times the federal poverty line is what's called your modified adjusted gross income. And as I mentioned in previous videos, you may have seen or heard of the acronym MAGI, M-A-G-I, modified adjusted gross income. Well, there's not one universal MAGI. Different tax provisions have their own unique brand of MAGI. This ACA premium tax credit is no different. So it starts with your regular adjusted gross income, which is line 8B from your tax return. And then you have to add back in tax exempt interest, like interest you got from municipal bonds. You have to add back in the portion of your Social Security that was not taxed. So normally, well, not normally, but in all cases, Social Security is no more than 85% of your Social Security is subject to federal income tax. The other 15% is kind of a freebie federally. Well, for purposes of this MAGI, for these tax credits, you need to add back in that 15% that wasn't taxed, or whatever percent wasn't taxed in your case. So your gross amount of Social Security is included in your MAGI. And there's a few other stragglers like foreign earned income that you were able to exclude that needs to get added back in. Most cases, people usually don't have that, but especially if you're on Social Security, that definitely plays into it because, again, the untaxed portion gets added in, and people who are heavy into municipal bonds for their tax-freeness, that can bite you a little bit when it comes to this because that tax-free interest gets tacked back in. So that's your MAGI. That's what's included. So Betsy, you asked, are there income streams that do not count? Yes, Roth withdrawals. If you have a Roth IRA, and Roth is, at the risk of overhyping it, we talk a lot about the benefits of Roth accounts. Withdrawals from Roth accounts are tax-free and are not included in your AGI, therefore not included in your MAGI. And not just for these tax credits, but for anything we've discussed, like how much of your Medicare premiums are subject to tax. That's based on your AGI. Well, Roth withdrawals aren't in your AGI, but regular IRA withdrawals or regular 401k withdrawals are. Those are taxable sources of income. They're included in your AGI. Roth withdrawals are not. That's one of the big beauties of Roths. Similar note, Roth conversions are included. And I see this question a lot. People who are on or have ACA insurance are interested in or currently getting these premium tax credits ask, will Roth conversions mess up my ability to get a credit? The answer is yes. Well, they may. Depends how much you convert. But every dollar you convert is included in your AGI and therefore will count against you in your MAGI for purposes of measuring your AGI versus a threshold. And Betsy, also you asked, want to be inflated. So what happens is when you start getting, so let's assume you retire mid-year. Therefore, let's say you start one of these ACA policies mid-year, you had employer coverage up until then. When you start and you apply for insurance through healthcare.gov, you put in estimates of your income. So for that year, yes, if you had half a year of earnings, it's inflated. It is what it is. You're kind of stuck. You can't undo that half year of AGI. But in subsequent years, you basically project, you tell them, you estimate what you think your MAGI is going to be for the year, and they'll give you the tax credits. And that's a good point that I meant to touch on earlier. So these are tax credits, but one of the big benefits of them is you can get them paid in advance. So let's assume you retired in December. You'll have no wages starting in January. So you also sign up for ACA health insurance in January. At the time you sign up, the application will ask you to estimate your AGI for all of that year. Based on what you say, they'll figure out, okay, this is what tax credits you can expect to get when you file your tax return, a year from now. But you can opt to have them give you those credits in advance. And this is why I call them subsidies. Let's say you're eligible for $500 a month in tax credits to help pay your premiums. Well, you can elect to have the IRS or the Treasury send that $500 each month to Aetna or whoever your insurer is. And if your policy was $900 a month in premium, Aetna will deduct, they'll drop it $500 and you only have to pay $400 out of pocket. So that $500 tax credit you get is paid basically now. So you can benefit from it now to pay lower premiums now. When you do finally file your tax return at the end of the year, then you have to true up, okay, I know how much tax credit I got based on the estimates I gave 12 months ago. Well, now the year's over, I know what my actual MAGI was. To the extent there's any difference, you either get paid back more or you need to refund some of those premium credits you got paid in advance if you got paid too much, based on what your income actually ended up being. Make sense, Betsy? I think that answered, hopefully answered what you were asking. Okay. Yes, Jackie also added in, thank you, that HSA withdrawals similarly don't count against your MAGI for purposes of these ACA premiums. Cody just chiming in more about Roths and the beauty of Roths. Willie, your contributions to a traditional IRA are not included in MAGI, right? Correct? Yes. I'm just looking at the 1040 here. I believe that's accurate. The deduction comes out it gets adjusted out of your AGI. So yes, not 100%, but like 90% sure that yes, IRA deductions will reduce your MAGI for purposes of this. I don't believe they get added back in the MAGI calculation. I have to double check, but I don't think so, Willie. Teresa, so Roth conversions only impact the years converted. In other words, if we do a big conversion in 2020, we may qualify in 2022, right? Yes, that's correct, Teresa. The conversions are only taxable in the year you do them. They won't impact other years. Separate issue, but with Medicare premiums, there's a 2-year look back. So the premiums you pay for Medicare when you're 65 will be based on your reported AGI, including Roth conversions that you did when you were 63. So keep that in mind for that. But for purposes of tonight's discussion and your eligibility for these ACA premium tax credits, no, conversions are cordoned off in the year you do them. They won't impact future years' eligibility. Okay, so Susie, good question. Is subsidy of one-time poverty level higher than 4 times? Yes, let me get to that now, actually. Perfect segue, thank you. So, okay, so we talked about what MAGI is. So that's the measure of income that's used against, to benchmark you against these federal poverty levels. There's 3 sets of tables. There's one for the lower 48 states and DC, one for Hawaii, one for Alaska. Those have their own. So let's start walking through this. So this is the lower 48. Let me just get this squared away here. The camera doesn't want to seem to focus, but hopefully you can see this. And this is all publicly available on Google. It's not hard. Just Google, federal poverty levels, and you'll find these tables pretty easily. But so it goes by how many people are in your household, dependents. So if you're single, for example, and you live in the lower 48, the federal poverty level is $12,760. That's real fuzzy. The camera doesn't quite want to focus, but believe me when I say it's $12,760. If you're a family of 2, so let's say it's you and your spouse, no dependents, no kids at home, the federal poverty level is now $17,240, and then it goes up a bit all the way until a household of 8. Then it's $44,120. So like if you're, a spouse and you have 6 dependent children at home, your federal poverty level is $44,120. Just for give you a flavor of the other states, so Alaska, family of 1, it's a few $1,000s higher, it's $15,950, and Hawaii is family of 1 is $14,680. So here's how it works. Now, and this gets to the question of is the amount you pay scaled based on how high you are relative to federal poverty level? Yes. The short answer is yes. This is where it gets a bit technical, so stick with me here. Just see a handful of comments pop up. Let me just take a look at this quickly. So Susie asked, before able to pull income from 401k or pension, where would taxable income come from, age 55, 57? So Susie, I assume you mean you already retired, so your wages stopped and you're not yet 59 and a half, therefore can't pull from your tax-deferred stuff without 10% penalty. Well, you may be able to from your 401k. There's something called the Rule of 55. If you left work in the year you were 55 or older, you can withdraw from that plan without penalty. You'll still pay tax, but without penalty. But let's assume you can't. Then it's up to you. Maybe you won't have income. So if you have, let's say you're living those few years off of you parked $300,000 in cash to live off of. If you're just drawing money out of your savings account every year, that's not taxable income. The interest on that is, so maybe you have a couple $1,000 of interest for the year, that'll be taxable. But simply withdrawing money from your checking or savings account, that's not AGI. So that'll be zero income as far as this is concerned, if that answers your question. And this gets to the crux of good tax planning opportunities. I'm getting a little bit ahead of myself here, but your question, Susie, gets the mind flowing like, oh wow, there's ways, I don't want to say game this, but there's ways I can really manage and massage my AGI to keep it low to qualify for these premiums. And that's dead on accurate. You can, it's well within the law. So in your case, Susie, let's assume you stopped working at 56. You're not yet drawing from any other sources of income. Social Security's not on yet. You don't have pensions yet. If you can pull money from checking or savings account or even regular brokerage account where you're paying capital gains tax rates or something, you can keep your income really low, especially if you're just living off cash that you saved. You can keep your income literally zero or close to it to get yourself the maximum amount of benefit. So there is lots of like planning and tactical massaging of sources of income and stuff you can do to really take the most advantage of this. Now, this may all go away. Who knows? There's a post someone posted earlier that the Supreme Court will be hearing a case about whether or not the ACA was unconstitutional. I don't know if it is or it isn't, but there is a chance politically, depending how the election goes, whatever, ACA may potentially go away, or these tax credits may go away. We don't know. For now, we can't speculate. We do this with planning. You always want to plan based on what you know and what's legislation now. Keep in mind what may happen, what could happen, but don't bank on it until you know it's for certain. Just have it in the back of your head that, oh yeah, this stuff may go away, so maybe I want to really take advantage of it now while I can, because who knows if it's going to be here in 5 years. But anyway, yes, you can definitely tweak your income to keep it as low as possible. There are people who are millionaires that can report zero MAGI or close to it for purposes of getting themselves these potentially hundreds of dollars a month in tax credits to buy insurance. All right, so getting back to the question of, is the amount of the credit scaled based on your income? Yes, it is. And you can't see this. This is a little tight, so I'll just tell you in a nutshell. Basically, the way it works is if your MAGI is 1 times the federal poverty level, the government wants you to pay, you can't really see this, but it's 2.08% of your MAGI. They want you to pay that towards your premiums, 2.08% of your MAGI. If you are 4 times, all the way at the bottom, you may not be able to see it, but if your MAGI is 4 times the federal poverty level, they want you to pay 9.86% of your MAGI in premiums. Any premium cost above and beyond that, you may be able to get tax credits for. So you can see here that this is how it's scaled. It goes from 2.08 to 9.86% of your MAGI is what the government expects you to contribute to your premiums for these ACA health plans. Cool. I'm just looking at, wow, a lot of comments. Right. Yes, so Willie mentioned the rule of 55. Yes, Susie, good point. Sorry, I shouldn't have said zero. So yes, zero MAGI. This gets back to what I said in the beginning. If your MAGI is below the federal poverty level, then it's a Medicaid issue. And I'm not certain about all the rules and requirements to be able to get yourself into Medicaid, especially if you have hundreds of thousands of dollars of assets. So yes, I think the smart move may be pull yourself some income from somewhere to get yourself to 1 times the federal poverty level to get the maximum amount of eligible tax credit. So if you're single, that's $12,000 and change, unless you're in Hawaii or Alaska. And if you're married, it was $17,000 and change. Again, slightly higher for Hawaii and Alaska. All right. Cool. So that's the underlying premise. Depending where your MAGI scales relative to the federal poverty level, they want you to pay an increasingly larger portion of your MAGI toward your premium. Now, here's the technical part. I tried to make it as simple as possible, and I'll show you the actual tax return form that's used to do this. It's scarier looking than it is, so I tried to take just sort of the crux of it and put it into hopefully a pretty straightforward example. So the amount of premium credit you're eligible to get is benchmarked off of the second lowest cost silver plan. Let me step through what that means. So again, there's bronze, silver, gold, and platinum plans available on healthcare.gov, ACA health insurance. You're able to buy any plan you want, but the amount of credit you get doesn't change because you chose to buy the most expensive platinum plan or you chose to buy the least expensive bronze plan. The amount of credit you get is keyed off of the second lowest cost silver plan available to you, where you live in your state, in your county. If there's only one plan, then that one's deemed the second lowest. But if there's 10 different silver plans available to you, the government will take the second lowest premium of those 10. That's the benchmark plan against which they'll calculate your credit. So that's the background that you need for me to start walking through this. Hopefully this makes sense. I tried to do this as clean as possible. So the amount of credit you'll actually get is the lesser of two things. One is the monthly premium or annual, however you choose to view this, the premium amount of that second lowest cost silver plan minus your contribution amount. And your contribution amount was, as I said before, that percentage of your MAGI that the government requires you to pay towards your policy. So let's put some numbers to it. Let's assume the second lowest cost silver plan is $1,000 per month in your case, based on where you live and your age and your gender and whatever. But based on your MAGI and where you fall in that federal poverty range and the percentage they want you to cover, you're required to pay $600 towards your insurance. So the difference is $400. Again, the $1,000 is the second lowest cost premium for a silver plan. The $600 is your required contribution based on your MAGI relative to the poverty level. The difference is $400. So that's how much credit you're eligible to receive. Now, the reason why it's the lesser of two things is they're not going to give you more credit than what policy you actually pick. So let's assume you pick to go, I can't read upside down here. Let's assume you pick a gold plan that its sticker price is $1,500 a month. Well, great. That's not less than the credit you'd get. So you would end up getting $400 a month off of your sticker price of $1,500. So in net, you'll be paying $1,100 a month for this policy. Instead, let's assume the same thing. So your max credit's $400 a month. What if you found the cheapest policy you can find whose sticker price premium was only $350 a month? Well, guess what? You're not getting $400 of credit. You're only getting $350. They're not going to pay you more credit than what your policy actually costs. Make sense? So again, in this case, let's assume you picked a $1,500 a month gold plan. You're eligible for a $400 a month credit. You can either wait and get all these credits paid to you by way of your tax return as a tax credit, or what most people do is have them advance paid. So this $400 a month will actually come off the sticker price of your premium that you pay each month, so that you'll only be paying $1,100 a month, not $1,500 to Aetna or United Healthcare or whatever policy you end up going with. Good. Hopefully this wasn't too squirrely to follow. Alrighty, let's check some more comments. So I don't have that much left here. Let me check the comments. Terrence, what if I do too much Roth conversion? The MAGI is over 4 times the federal poverty level. No tax credit? Correct. No tax credit. So you got to be careful. Two things. So if you're forecasting your income at the beginning of the year, you want to try to get as close as possible. If you know you're going to be doing conversions or want to do conversions, definitely factor that in. Now, I'm not saying don't. Like if your AGI, your MAGI, for example, without conversions was going to be 389% of the federal poverty level, doing a conversion and knocking yourself out by a little bit may not be that much of a difference. It depends how much you're converting. And this is where it gets a little tricky. You're kind of weighing the long-term tax benefit of Roth conversions versus the short-term detriment of losing, depends how much, premium tax credits. If you're getting $1,000 a month in tax credit, you may not want to get rid of that with Roth conversions. But if you're, if you're only getting $50, $100, $200, it's tough. It takes some bigger digging and deeper analysis to figure out, is it worth biting the bullet and doing the conversion, or just don't and keep yourself these tax credits. Not a clean answer, but yes, to answer your question, if and when you go over 4 times federal poverty, boom, you get no credits. And to the extent you got paid advance credits during the year, you're gonna have to pay them all back at the end of the year. So you wanna really be careful, because you can get a nasty unwanted tax surprise if you got thousands of dollars of advanced tax credits during the year, but then you're over the 400% limit. You got to pay all it back. That could be ugly if you're not expecting that, Terrence. Jackie, are you allowed to deduct the premium cost for an ACA plan as a business deduction? Yeah, I think so. Good question. I have to look, but assuming you're actually in a legitimate business and you do file a business tax return, whether it's an entity, like a corporate return, a partnership return, or you're just filing it as a Schedule C as an individual. I believe so. Yes, Jackie. Willie, do they charge you a penalty or interest if you have to pay the subsidy back when you file your taxes because your Maggie ended up being higher than you estimated? Ooh, that's a good one. I don't know. So how paying estimated taxes and underpaying taxes is a real hairy calculation. Taxes you have withheld versus taxes you pay and estimated tax payments aren't treated the same. So there's some like safe harbors so that if you withheld at least 90% of the tax you owed this year, or at least 100% of what you owed last year, you're generally exempt from any interest and penalties. If you don't, you may be subject to interest and penalties. I don't know if the incremental taxes you owe because you have to pay back tax credits that were paid to you in advance, I don't know if those are subject to interest or penalties. I would like to think hopefully they're not and they're carved out from just other general underpayment throughout the year, but I'm not sure. To be safe, assume they're subject to interest and penalties to the extent you owe so much, you withheld so little that you do owe an underpayment penalty, but I don't know for sure. Willie, great question though. David, if your income changes during the year, can you inform the exchange so your subsidy will be adjusted? Yes, you definitely can, David. So if a life-changing event happens, you get hired back to a job you didn't think you'd get, or you get married and that now changes your federal poverty level, or you do some big fat conversion you weren't planning on because the stock market tanks, you're like, hey, this is a great time to do it. Yes, you can tell them, they'll adjust it and reflect it going forward for the rest of the year. Susie says, carefully planned Roth conversions while retired and still young could push your income up to 1 times poverty level. Yes. Yeah, exactly. So Susie, let's assume you had 0 income otherwise. So no wages, no IRA withdrawals, no pensions, no Social Security yet. Sure. If you want to get yourself to that $12,000 or $17,000 AGI limit, do a conversion. That would be actually the perfect time to do conversions because it's not knocking you out of eligibility. It's putting you into eligibility, right? And you're still be getting the maximum eligibility, and you get the benefit of doing a Roth conversion. And if your AGI is that low to start with, that amount of conversion is probably going to be completely tax-free because your standard deduction is probably going to more than cover it. So that's like probably the single most ideal time to do a Roth conversion, the single most ideal scenario, Susie. Great point. Cody, yes, thank you, Cody. So, okay, you can deduct your ACA premiums if you're self-employed. Cool. All right, a couple more things to show you guys, you all. It's interesting I just said you guys. So I went to this financial planning week-long intensive sort of, I guess you can call it training, and it was with people from all over the country, and we had to like role play and do these really hokey sort of mock financial planning scenarios. And without fail, everyone from the East Coast, so there's like a mock husband and wife, and there's a mock, one was a single person, one was husband and wife, these scenarios. And without fail, the handful of us from the East Coast all referred to the spouses as you guys, or guys, generically men and women as guys. And one of the moderators, who was from somewhere out west, said, I can tell you're from the East Coast because you call everyone guys, which was an interesting point. And he's like, some people get offended by it. Because guy technically means male, I guess. And he's like, don't call spouses guys. And then one of the other moderators there was from the East Coast was like, no, absolutely not. I think it's almost like a term of endearment, at least on the East Coast, because that's what people are used to saying. So anyway, I try not to say it so as to not offend anyone, but I realize I just said you guys to this audience of clearly mixed bag of people. So apologies if anyone was offended, but just brought up an interesting story about regional differences in terms people use. Y'all, yes, Betsy. I wish I can say y'all. I've never once said it seriously. I want to try, but I find myself struggling to find the right times to use it. Like I play around sometimes. I have some friends who live fairly south, at least south of New Jersey, and I say y'all, and they're like, nope, that wasn't it. That wasn't the right time to use it. So one day I hope to figure it out. Okay, so just a couple other things. This is the actual form in your tax return that you would do this all. It's Form 8962. without stepping through everything, this does the calculation I discussed. You put in your Maggie, you put in your federal poverty limit, you do the percentage of how much you owe based on the table I showed. That'll tell you like the total contribution. Then this table down here, you can either do it monthly if you need to prorate by month, or you can just do it annually. It says, the total premiums you paid for or will pay for or actually paid because this is retroactive. Total premiums you paid for the actual policy you have, total premiums for the hypothetical second lowest cost silver, your total contribution requirement, what's the difference, that's your credit. What credit were you paid in advance versus what credit are you actually owed all said and done. And then the bottom is if you owe it back, give it back. If we owe you extra, we'll give you extra. That's all this is. It looks scarier than it is. It's really not that bad once you step through it. Quick fun fact. So not everybody needs to file tax returns. Like if you don't have any taxable income, you don't have to file. Even if you do have taxable income and you're owed a refund, you still technically don't need to file. You'd be silly not to because you're leaving money on the table, but you don't have to file. So it's fairly common with retirees or people of low income who aren't getting certain subsidies. You don't need to file because if you only have $10,000 of taxable income, of gross income, but your standard deduction is $12,000 or $24,000, you have zero taxable income, you owe no tax, so you don't need to file. If you had tax withheld, you want to file to get that refund, like I said, but whatever. So anyway, there's lots of times where retirees don't need to file a tax return. If you are getting or want to get tax credits, you will need to file a tax return because this needs to be part of that tax return. You can't just send this in by itself. This needs to be appended to a proper 1040 tax return. So this is one of the times where you will need to file a tax return regardless. Even if you don't owe any taxes all said and done, you'll need this. You'll need to file this. And one other thing for y'all to take away from this, was that good, Susie or Betsy? Did I use that right? Y'all, if y'all are interested in learning more about tax credits, Google IRS publication 974. The IRS actually does a really good job of putting out what they call these publications. Some of them are pretty thick and wordy, but this is really all you need to know about the premium tax credits. Now, I just took the cover. This is, I don't know how many dozens of pages, 78 pages. There you go. It's a lot to read, but extremely, extremely informative and educational and written in pretty plain English, other than when they get to formulas and they need to start digging into numbers. I like these a lot. You can learn a lot about lots of things about taxes and tax planning by reading these. Anyway, this is the one for premium tax credits for those of y'all that are interested. All right, and Cody Garrett just posted a link to that. Thank you, Cody. So is that all I have? Yes, that's all I have. One thing I wanted to mention, just to put some dollars to this, or potential dollars, it's going to depend drastically, as you can tell. So right off the bat, the policies available to you and the prices of those policies can vary wildly based on where you live and your gender, your age, etc. The amount of the tax credit is standardized based on these formulas and your Maggie and whatever, but the policy prices could be very different. The second lowest cost silver plan for me in Middlesex County, New Jersey, can be very different than a plan for someone who's 60 in, I'm making up a county, Buena Vista County in Los Angeles County, or whatever, assuming that's a county, in California. So it could be very different. But Jackie Cummings-Koski, who posted a lot here, earlier today, a couple hours ago, she actually posted a really great table in the group of her research. I think it was across 4 or 5 states, if I remember correctly, Jackie. When you went looking yourself for ACA policy, you posted up, the premiums and the credits and stuff based on your research. Now, everyone's own numbers could be very different, but it was very helpful for you that you posted that. So thank you, Jackie. One other data point I have. So Betsy grew up in Pennsylvania and says, y'all, cool. Are you like the western part of Pennsylvania? That's basically the South, or did you move to the South? Anyway. So, one other data point I have, I won't name names or anything, but single female, early 60s, got a bronze plan with a high deductible, so it's eligible for HSA, which means its premium ended up being $1,000 sticker price premium, getting a monthly credit of monthly credit of $700 per month for a Maggie of 20 grand. I think it was 20 grand. And it was like $660 a month for a Maggie of 25, and then drop down a little bit from there. So that's real money. Do the math. $700 a month times 12 is $8,400 a year in tax credits. Now, granted, not everyone is in the position to be able to have such a low Maggie. Like if you're already getting a pension, you're already getting Social Security, you're kind of stuck. Your income is what it is. You can't reduce those, or you'd be silly to reduce it and give up money. But to the extent you can manage and keep your Maggie low, there's some real money here. Hundreds of dollars per month, thousands of dollars per year in these tax credits. So it's not something to overlook if you're eligible for it or able to get yourself eligible for it. All right, I'm done with my spiel, so I will take whatever comments, questions you have here. Bunch of y'alls, thank you. Yes, good. Susie's from Georgia, definitely y'all down there. Oh, good. Los Angeles is a county in California. Good to know. Thank you. Bud Blower. It would be use guys. I actually said use guys one point in college. So I went to University of Delaware, which is predominantly New Jersey, Delaware, Pennsylvania, Maryland, and then a little bit of the periphery around that, New York as well. Someone from Maryland called me out real quick the first time I said use guys, and I've never said it since because that is burned into my mind, getting caught for saying use guys from me from New Jersey. All right, what else we got here? And Wisha, family of four calculation. Does this mean till kids are 26 you have family of four, after which it is family of two? That's a good one, Wisha. I'm not sure. I don't know, for purposes of these tax credits, how they treat dependents and who can be claimed as a dependent on your tax return. I don't know if they define it as, what is it? Is it eligible child or something, where in which case it's only 17 or up to 17, or if it's up to 26. I would need to look into that. I'm not sure. That's a good question. What else we have? Yazins. I like that one. Okay, y'all come back now. You hear it? Good, thank you. Yes. Okay, yeah, Jackie's just saying subsidy of $400 a month times 12 months, almost $5 grand a year. Final cost of premium is $54 a month. So yeah, that's clearly real money. I mean, to put it in context, that's a pretty good car payment, $400 a month. So it's definitely worth pursuing these if you can get it or manage yourself to be able to get it. All right. That is all I have. Hopefully you found this enjoyable. Sorry it was a little thick and technical, but I tried to do the best I could, making it straightforward. Next week's topic, I believe, is the 4% rule, I think. It's either that or annuities, one of the two. Either way, they'll both be thoroughly invigorating. Hope you join me for those. Until then, I will see you all next week. Thanks for joining. Take care.